They'll probably hike again in December, and then we'll call it an open question whether they hike one more time in the first quarter of next year. That is almost done. So to your point about wait and see, at that point, assuming things unfold the way that we expect, and of course we know that always happens, they'll wait and see.
Yeah, assuming they don't break the vase along the way.
But this has been my point with you all year. This is what they do. They tighten too much because it's 12 guys and girls in a room trying their best to bring inflation down. They're not going to get it right because they're human. And the most likely outcome is that they cause some distress more broadly and in markets. And you've seen that already with the stock market down 25%.
All right, so let's bring in CNBC contributor Stephanie Link of Hightower, Sean Cruz of TD Ameritrade to continue the conversation. Steph, what's your reaction to what Diamond said? By the way, I'm going to play another clip of that on maybe what the ultimate conclusion is about what the Fed does. But what about this notion of the market? 20%? Maybe easy. And it's going to feel a lot worse than the first 20 did.
Oh.
Steph's frozen. Sean, can you hear me?
Sorry, am I frozen?
No, now you're not frozen anymore. You're back. You're thawed.
No, I'm not frozen anymore. I'm back. All right. I'm not surprised. I don't know if we're down another 20% from here. We're already down quite a bit, Scott. But we've been talking about it all year long that the market's churning and it's in a choppy trading range and it's volatile because there are too many unknowns. I 100% agree with him on all the things he listed on what we don't know because we don't know about the Fed. We don't know about if they're going to be able to get inflation down. Doubtful. They don't have a great track record, but that's another unknown. The economic data, we are definitely seeing a deceleration, except in the jobs market. Every place else, it's decelerating. War, currency. So across the spectrum, there's a lot of unknowns. Markets don't like unknowns. Higher interest rates are really bad for long-duration assets. Long-duration assets tend to be technology and growth stocks. Technology and comm services are 35% of the S&P 500. So I kind of thought last Monday and Tuesday was silly that people thought that the Fed was going to pivot. They can't pivot. The inflation is way too high. Core PCE at 4.9%. The CPIs and the PPIs this week are going to be north of 8%. Even if they come down and they're a little bit better than expected, it's way too high. So the question you guys were just, the biggest question that you guys were just talking about is when will the Fed hikes actually be felt? And it is going to be something like 2023. I think it's sometime in the first half. The irony of all of this is the Atlanta Fed GDP now. They actually revised GDP for the third quarter to 2.89% from 2.7. So the growth is still here. Momentum is still here in the economy, but it's slowly going south.
I actually think the biggest question now is what are they going to break along the road? Right. And that's sort of what Diamond discusses earlier. Sean, listen to Jamie Dimon today discuss the economy, the Fed, the fallout, and we'll talk on the other side.
Currently, right now, the U.S. economy is actually still doing well. Consumers have money. Fiscal stimulus, they still have more than they had before. They're spending 10% more than last year, 35% more than pre-COVID. Their balance sheets are in great shape. Yes, debt's gone up a little bit, but not nearly to pre-COVID levels. And therefore, even if we go into recession, they're going to be in much better shape than 08 and 09. Companies are in good shape. Credit's very good. Markets are still open, though rocky and stuff like that. But you can't talk about the economy without talking about the stuff in the future. And this is serious stuff, okay? This is inflation, which obviously is changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6-9 months from now. The one guarantee, which we've been consistent about, is volatile markets. You're going to have volatile markets. You've already seen markets down quite a bit, no IPOs, very little high yield, bridge loans being hung and stuff like that, which is pretty typical, but it's still been orderly. I think it's possible you're going to see it be disorderly sometime in not too near future.
Right? Disorderly sometime in the near future is a possibility. So Hurricane Diamond suggests that it could be a Category 4 or worse. If you need money, he said, go raise it. That's the line that stuck out to me, maybe more than anything else. What about you?
Yeah, I mean, I think right now there is a lot of attention being given to credit markets because we haven't really seen a lot of the distress you would associate with an economy that is potentially going to head into recession. You're not really seeing that show up in terms of defaults or the expectation for defaults getting priced in. So if we do get a scenario where liquidity dries up to the point that credit markets start to dry up, that can really be something that is going to impact assets across the board. The one thing I think looking at this going into it, and why he mentioned the balance sheets being in pretty good order, which might help weather any sort of a recession or a slowdown, but also I think just in the financial system leverage. If you look at the FINRA margin debit numbers, leverage has actually been coming down all year. So we're also not sitting on as much leverage as, say, we were when we were up around 4,400. That coming in could also be something that may limit the volatility we see if we do see an acceleration of selling on the downside. The fact that there's not as much leverage that has to get pulled off the table alongside that could be a calming factor. So I think it will be interesting to see if we get that recession in 6 to 9 months, really how deep is that recession going to be felt? If it's a little bit more moderate, I think you can actually see equities in particular hold up a little bit better.